and a warm welcome to one and all. So, I'm back from my holidays. There was a little bit of an update while I was away last week, but what a difference a week makes. Boy, oh boy, has it made a difference. And is Scruff happy? Scruff's got his coffee, so we all know Scruffy likes his coffee, but damn right he's happy. In fact, I might even be celebrating tonight. And why? Well, we're about to have a look. Now, it was said that compounding is the eighth wonder of the world. And to be honest, it is. Very, very much so. And we're about to prove that. And this is why Scruff is a happy boy. Now, I started the new financial year on the 1st of April. And we saw that. And the figures, I actually didn't achieve what I wanted to achieve last year. In fact, I was quite disappointed because I did achieve the 175,000 that I wanted. But then obviously the Middle East kicked off and various other bits and pieces, and the fund took a hit. Now, in that case, was I worried? Because next to compounding is another wonder of the world, which is called DCA. Now, that's called dollar cost averaging. Now, it's just a name that it has, but if you're in the euro, it would be euro cost averaging or pound cost averaging, where I am in the UK. But essentially what it means is, as the market moves against you, as long as you have faith that you have the direction of travel correct, what you're actually doing is you're getting in at a better price. Now, this doesn't matter whether you're trading or investing. The principle is the same. Now, when you're investing, your direction of travel is not over the next week or 6 months. It's the direction of travel over the next 6, 7, 10 years. Now, when I started this fund, and I started it on the 1st of January in 22, okay? And here we are now in 26. So this journey started a while ago. And I started it with a very small sum. You know, it was under £1,000. But the principle was, if I keep drip feeding into this, over time, it'll pay off. Because the vision in 22 was to run it for 10 years. Well, we've been running it a little while now. We've still got a while to go. So as we go through the journey, you'll see it build up. And that's what these updates are all about. The one, to kind of answer some questions that are given. And secondly, just to show you that it is possible in real time with real money. Because that's what I do on my other channel, which is the Scruffy Trader. Because not only am I an investor, I'm also a day trader and a market analyst by profession. Why is that? Well, it's my job. And where did it come from? Well, I used to run a mail order company. I was the managing director of a reasonably large one for over 17 years. Prior to that, I worked in the blue chip industry. The blue chip industry taught me how to run a business. So they put me in night school, business management, business finance, etc. And then I went off and started my own business and took those skill set into that. Became a forward purchaser as part of the business that I was in, which meant I had to watch and understand how the markets work. From there, I just built up a portfolio and one thing and another. And when that company closed in 2017, I just carried on doing what I'm doing. So what it shows is grit, determination, but more importantly, key planning can help. Because if something goes catastrophically wrong in your life, it's not the end. It can actually be a reset and start again for something different. Now, that's what the markets are. The markets constantly reset and move forward again. So don't ever think that a market crash is bad, because I can take personal life experiences where you crash and burn, but you come out the other side better for it. Now, everybody's talking at this moment in time about the AI crash and that the markets are oversaturated. This is going to happen and that's going to happen. But do they know? Well, personally, I don't think they do. And you can talk to as many boffins as you like. What they are talking about is an instinct. It's a narrative that they think. How many times have you seen the market and it's very, very high and you think, well, that's the ceiling. It can't go any higher. But then it does. Look at the markets today. They are higher than anything would ever have expected. But it keeps making new highs. Now, I have my own personal feelings as to why this is. We look at the gold markets, which are traditionally massive, although it lost 2% today on the spot market. So if you're trading gold as a day trader, I think you're fucking stupid, because it's moving 2% in a day. It'll kill any account. But what it can do as an investor is give you an opportunity to get a good price. So the investing mentality is completely different to a trading mentality. Now, what I'm thinking at the moment is this. I think it's a battle between new money and old money. Now, when the stock market is shaky or the world is uncertain, as it certainly is at the moment, certainly in the UK, if you look at the political circus that's going on here, people are very nervous. So what do? Would you put that into the UK economy or the UK stock market? The chances is no, you won't. Not if you're old money. Old money are conservative. They want steady growth. They want steady returns. They don't like frightening things. So they'll put it into safe haven. So that is the likes of commodities. So they'll move that money into gold. Now that's holding gold prices up. Now with the stock market, say the S&P 500 for argument's sake, that if gold is high, in theory that should be low, and vice versa, because it's basically risk off, risk on. Stocks are risky, commodities are safe. Now that's not happening either. They're both going up in the same direction. So my theory is this. I think old money is going into traditional value and new money is going into risky stocks, which is the AIs of this world and the technology of this world. Why? Well, it's in everybody's psyche, but there's a bit of a difference here because everyone's talking about the bubble burst, as I said. But will it? Well, think about this and think about this logically. Why would it burst? They're talking, saying it's overinvested. The income coming in is not going against the debt going out. However, Amazon many, many moons ago was in a similar situation. Now it's one of the most powerful, profitable businesses on the planet. Now, this happens over and over all the time. You know, you'll see a company that should be failing, but it doesn't because it keeps on going. It has grit and determination, which was the start of this monologue. Now, what I'm driving at here is I don't think it'll burst because I think they're too big to burst. The ones that are controlling the AI investment are the big players. It is Meta, it is Google, it is Amazon, X, all of these, you know, ChatGPT and all these different companies that are in and around the AI space. Yes, there's going to be some losers, some big losers, but they'll be the little companies. The Goliaths are going to win. And because they're going to win, the stock value will stay high because their value is massive. But why will they win? Well, in the 90s and one thing or another, you had the dot-com race. Every man and his dog that had .com on the end of a website was seen to be worth a fortune. But then it burst. Why? Because it wasn't built into our lives. It never had any effect. You know, John Smith's Sheds.com could be valued a fortune today, but who gives a shit about it? Nobody gives a shit about it because nobody cares about sheds, right? But AI is slightly different. It's actually part of the workforce now. You pick up a phone, a lot of the time you don't even know if it's an AI you're speaking to, and if it's a chatbot, the chances are it is AI you're speaking to. So it's actually an employee. Whereas the sheds.com is meaningless. Because AI is entrenched into our lives, it will be too big to fail. Now, whoever controls that AI is going to be the survivor, but it won't be a monopoly, because there can't be a monopoly because of monopolies, competition law, and one thing and another. There has to be some kind of split. So there'll be a top section of companies, and that'll be it. So I don't think it's going to burst. Is it going to keep on booming and booming the way it's going? I'm not so sure. There will be a reset, but I don't think it's going to be as bad as you think it is. In fact, the way people are talking, yeah, if there's a 20-30% reset, is that really the end of the world? Because every time there is a reset, there's a rebound. And not only does it rebound, it rebounds about 20% higher. So it'll come down 30 and it'll go up 50. So I wouldn't worry, not too much. And this is why Scruff's a happy boy, and why I started saying that compounding is the eighth wonder of the world. Because if that reset comes, lean into it. Don't be scared of it. Think, brilliant, I'm going to get a good price. And that's business 101. Buy at a good price. Now, what happens from there onwards comes down to a little bit of timing as to the way that you want to do your fund. Now, for me, I'm looking at it I'm pretty much retired now, but I want to be fully retired in about 4 or 5 years' time. You know, so I'm 56, and when I hit 60, I'm pretty much done. You know, I've kind of done my thing for king and country, and I want to enjoy what's left of my life. And this is what this is all about. And I also want to set up my kids. My own kids are fine, but my grandkids I do worry about. And I want to ensure that there's a legacy left for them. So this is all part and parcel of what I do. Okay? Now, with this fund, if I can get it self-sustaining, which you're about to see, it can be done. And as I said at the start, it started very small. So let's have a quick look at it. And you tell me. You tell me whether I'm right, wrong, or indifferent. You know, if you like it, hype the channel. I would really like to see it grow, because I do get interested in other people's thoughts. And it doesn't matter if you're wrong, you know, or if I'm wrong. Say I'm wrong. This is open debate. It's humanizing. And that's the beauty of the world, or at least it should be. You can have two different people posing positions and both believe they're right, but still be friends. There's nothing wrong with that. It's when one side needs to beat the other side into oblivion. That's wrong, you know. And the problem with this industry, and certainly on my other channel, is people don't understand that you can have difference of opinions and still be friendly to each other. You should always have love and peace. Okay, so what can we see? Well, we can see the fund is now 202,000. It's nearly £203,000. Now, for the period that I've been doing this, that is phenomenal. You know, I am over the moon with how well this has gone. And what we're going to do is we're going to update the quick sheet, but we'll go through this first. So at the moment, over the last rolling year, I've personally put into this, from my other income streams, £52,000. Okay, so that's my personal contribution into it. What it's actually made on those contributions is nearly £37,000 this year. So this is effectively making a wage per year now. Okay, so give this 4 or 5 years, that's it. I'll be done. All right, I won't need to add into it anymore. Now, when you look at the way that it works across the months, it isn't always singing and dancing. In fact, here we are in March, and this is what I was talking about. When it comes down on itself, it will rebound and then rebound some. So it lost the thick end of, and it's why I was really annoyed with it, because I really wanted to achieve the 175,000 as the year target. It failed. It actually ended the month at 174,000. I was annoyed. And in April, it went down again. So and I was like, oh, for Christ's sake. It was like, oh, here we go. Gonna have to battle my way out of this. But I stuck to what I knew because I trusted it. And it rebounded back. Okay, so there's the figures. So we do have red months, and as we pointed out in March, some of those red months are horrific. But keep on going. Put your payments in, your transactions rather. As you can see, I'm just dumping money in. That was me changing funds. I took it out of one fund and put it into another. I was rebalancing the books. But as you can see, I'm just drip feeding in all the time. Even sometimes just 18 quid. You know, make a little bit, put in here. 50 quid, 6 quid. Doesn't always have to be big figures you're putting in. Again, I did a bit of rebalancing here where I sold it out of one and put it into another one. Because I was changing it from the NB to the AB to an NB. Because the North American all caps seem to be better and cheaper. So that's why I did that. And again, it was rebalancing. So there's a few of the figures. And as you can see, they're not massive amounts I put in. I just drip feed over and over. And that's what I do. Now, from the investment point of view, we can see where we going with this. And then there's the holdings that I have at the moment. So essentially work on 3 pots, which is this global all cap. It's ethical and it has emerging markets within it. Does quite well. The FTSE all cap, it's just across the board. If one falls off, another one picks up, because I'm a good believer in you buy the haystack, not the needle. Oh, talking of the needle, here she comes.
You brought your coffee?
I was talking. I was, but see that? I'm like a dog with 2 cocks now. I've got 2 coffees. What?
I'm going out, so I brought you a fresh one.
Oh, you're good, you, aren't you? I prefer it if you came up with no clothes on, though.
Is that right?
Oh, God, yeah.
I won't be long.
Sorry about that, boys and girls. Got 2 coffees now. Oh, God, it's almost like Christmas, isn't it? Anyway, cut long story short, I keep my pots relatively simple because if you're trying to pick the stock, you'll probably find that quite difficult. So just buy them all, and then they'll balance each other out. And then the overview, so you can see exactly where the holdings are and what they do, is here. So this is the bit we're going to update. So what we can see now is we have an ISA section, which is 5887018. We have the quick fund. This is where if I just need to get some money relatively quickly, we've got 20,791.64 in there. I've got a pension pot in there for 122,721.42. And this is the one that I'm kind of interested in because all I do with this one, call it the treat. I'm going to have a little bit of a something when I finally cash this in. Started with I think it was 360 quid or something we put into it. And then I'm just going to put 25 quid a month in it and then just see what happens with it. That's it. So I'm not adding into this as and when. It's just 25 quid a month from an initial sum that I had. And we're just going to see what happens. Well, it's running at a personal return. Here it has 15.8. There ain't a bank in the land going to pay you that. So it's chugging along quite nicely as well. So that works on that. So what's the growth from the last time that we did this? Well, the last time I checked it on the spreadsheet, because obviously I was on holiday last week, was the 1st of May. So how well has it done? Here we are today on the 15th of May. Well, let's drop this in and we shall show you. We've done it, boys and girls. It's hit the target of 200,000. It's over that target considerably. Scruff's a happy boy, right? But as we saw with the monthly breakdown, don't count all your chickens at once. I was over the 175,000 target last year, but the last month kicked it right in the arse and put me below the target. So this year I was relatively conservative, as you can see. We started the beginning of the year when I updated this. The balance was 177.99 on the day that I made this sheet, and we now well in excess of that. In fact, we've done 30 grand over the last sort of 6 weeks or so. I think that's pretty good going. But it's only good going because it started very small and then built into something substantial. So the first couple of years of this fund hardly did anything. You know, it was just chugging along and it was just, say, getting better than the bank. But the compounding effect started building up. And that's why it's the eighth wonder. Because you have £1, you make 10 pence. You know, it doesn't sound a lot. But when you come into it the next year, you haven't got £1 anymore. You've got £1.10. So that starts working. And then it starts building and building and building. Now, the trick with any fund like what we're looking at here is don't take anything out. Let it continue to do its thing. Now, up here in the top corner, you should be able to see it if I just scream this over. There you go. 1st of January, 22. And that's it. So, Scruff's a happy boy. More than smashed the target. We good. So you tell me. Drop down in the comments, hype the thing. Let me know. Has it done well? Or do you think it's just a flash in the pan? So there you go. If you enjoyed this, take time to have a look around the website, scruffytrader.com, and just subscribe. See you all in the next one.